Hey guys, today I want to talk to you about how you make money with a stock. Now, before we get started, I do want to say if you enjoy this kind of content and you're interested in learning more about stocks and how you make money and how you really succeed in stock trading, I recommend you check out the link below in the course description for my course from LinkedIn Learning. This course on trading stocks and financial basics and understanding capital markets will give you all the tools that you need in order to really get started and sink your teeth into the investing world. The nice thing about LinkedIn Learning is that you get a free 30-day trial up front. So go ahead and click that link below and that'll take you to the free 30-day trial option. All right, now let's talk about stocks. So, Oracle is the company that we're looking at today. How is it you go about making money on a stock like Oracle? Well, there's really two options. The first option for making money in a stock like Oracle is based on what we call the dividend. Now, the dividend is just a piece of the company's overall profits. In other words, it's a portion of the money that the company makes, and they turn around and pay that money back out to the owners of the company. That's you, the shareholders. So in this case, Oracle pays a dividend every quarter, every 3 months, of 24 cents. Basically, if you own a single share in Oracle for a year, you get paid, in this case, 24 cents per quarter, or roughly 96 cents for the year. Now, that doesn't sound like a lot, of course, but you're only paying $53.20 for the stock in question. So this means that you're basically getting about a 2% dividend yield, 1.8% to be more precise. This dividend yield can grow over time, though. So Oracle's EPS, or earnings per share, for the last 12 months were $3.17.7 per share. Basically, the company made just about $3.18 per share over the last year. They turned around and paid 96 cents of that out to stockholders. Well, what did they do with the rest of the money? They're reinvesting that into the business, trying to grow those earnings for the future. But they could easily decide that they want to pay more money out over time. So your dividend can grow over time as your earnings do, or as the company decides to up that dividend. That's the nice thing about the dividend. Compared to something like your CD down at the bank or your savings account at the bank's not going to give you a higher percentage rate over time. They're not going to grow that significantly. Dividends do grow over time in general. So that's one way you can make money with a stock. Now, Oracle pays their dividends once a quarter. In order to get Oracle's dividend in this particular case, for the first quarter in 2020, you would have had to own Oracle by what's called the ex-dividend date. That ex-dividend date for Oracle is April 8th, 2020. As long as you own Oracle stock by that point, you get paid that dividend on April 23rd, 2020. Once we move past the first quarter, there will be a new ex-dividend date. That next ex-dividend date, as an example, might be July 8th. Or, in the third quarter, it might be October 8th or September 8th, whatever Oracle decides. And then the dividend payment date tells you when you actually get the cash from the company. So that's kind of the base way that you make money on a stock. The other way that you make money on a stock is based on trying to buy low and sell high. So look at what happened to Oracle over the last year. Well, the stock was trading for around $55 a share, sometimes a little over, sometimes a little under, for most of the last year. Then what happened in early 2020? Well, the stock price kind of fell off a cliff. It got to as low as just about $40 a share. Why? Largely due to the coronavirus and kind of a scare around that. So if you'd bought Oracle when the stock price was coming down, and that's hard to do because it's scary, but if you'd bought Oracle when the stock price was coming down, let's pretend you'd managed to buy it at $40 a share. Well, you would turn around and just a few weeks later, you could sell it for $53.20 per share, meaning that you would have made $13.20 per share. You'd have this big profit locked in just a few weeks. all because you had the courage to buy when the stock was falling. The key, of course, is to understand when a stock is falling for non-fundamental reasons, when it's falling for a bad reason, rather than when it's falling because, hey, the company's falling apart and it's getting ready to go bankrupt. All of this comes down to what we refer to as the PE ratio. So this chart shows us the PE ratio over the last 12 months. And in Oracle's case, that's 16.75. Now the PE ratio, or price to earnings ratio, is just the stock's price divided by its earnings per share. So $53.20 divided by $3.18 gives us that 16.75 PE. Now, these things don't always work out precisely. Sometimes the math that you'll see on a stock quote is a little bit off from the PE ratio just because they might be looking at a slightly different set of earnings, or the stock price might have moved just a little bit before they could update the PE ratio, whatever. But by and large, what this is showing us is that you're paying 16.75 times the company's earnings whenever you buy the stock. In other words, it would take you about 17 years to earn back all of your money just based on the earnings itself. Fair enough. So that might sound high to you, or it might sound low, right? Depends on kind of your perspective. But if you were to buy one share in Oracle today, if the earnings stayed flat, if the earnings never went anywhere, then it would take you 17 years to get all your money back. So low PE ratios are good. They tell you you're buying the business for less, relatively speaking. If the PE were 2, then it would tell us that, hey, it's only going to take us 2 years to make our money back based on earnings. High PEs are not as good. But there's a caveat here. Are earnings growing? That earnings per share, that's not going to stay the same over time. If we look at a company like, as an example, Amazon or Netflix, they're growing their earnings really fast over time. Google might be another one. Facebook, Microsoft, compared to somebody like Macy's or an IBM or a General Electric, they're not growing their earnings as fast. They've struggled a little more. So you always have to ask in the back of your mind, is that PE ratio high because we're also going to grow the earnings really quickly? That PE ratio is backward looking. If we see that the PE ratio is low and we think that earnings are going to grow fast in the future, well, then that's a great stock to buy. And if the price is falling, we'd probably want to load up the truck on it because it's going to be a really sound investment over time. As long as A, we see a low PE ratio, and B, we're confident those earnings are going to grow over time. And that's how you make money in stocks. I'll see you next time.